Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a network for family offices based in Greenwich, Connecticut. Circulus will be hosting its next Family Office Summit on May 15th in New York for 75 family offices and will feature Roger Ferguson, former Vice Chair of the Federal Reserve, in conversation with Rebecca Patterson, a former and very popular guest of this show. If you are part of a single family office, you can apply to attend at circulus.substack.com. Today we're charting the remarkable trajectory of a wealth management powerhouse, Pathstone, with Matt Fleissig, co-founder and CEO. Pathstone is a great case study for the major trends in wealth management over the last 10 years. Pathstone's DNA was from the well-known Harris MyCFO, which was the original .com family office formed by the founders of Netscape and WebMD. Pathstone has since grown into a firm managing and advising on a remarkable $162 billion in assets. Matt has been a key architect of this growth story and will explain how they navigated the complexities of multiple notable acquisitions, how they developed their unique business model, which has turned services into a revenue generator, and their recent notable acquisition of the $45 billion Hall Capital. Please enjoy my conversation with Matt Fleissig.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
How did you get interested in investing?
My investing started, you're going to laugh when I tell you this, but in college, we won't talk about my grades freshman year, but I was a computer science at Harvard, and that was in the IPO days. And E-Trade would offer you, if you were opening an account, basically 50 shares an account. And so what happened also at the same time is you had to confirm those shares. So I was an econ major and computer science at Muhlenberg. And during that time, I started writing some scripts, two things that were going on. It was also the early days of eBay. And I ended up writing code that was able to auto-confirm the IPOs on the E-Trade site. And at the same time, I wrote some code that allowed to notice when certain sites updated to sell things on eBay. When the early days of PlayStation and Tickle Me Elmo, some of those early hot items that were selling in the late 90s. And I was to say on the IPO side that I got involved. I learned the most valuable lesson that could ever be explained. Anything that I made off the IPOs, I ended up putting into Lucent and Cisco. And so let's just say at the height, I thought I made a small fortune in college, and I spent some, don't get me wrong. I had a little bit too good of a time, but I learned quickly that I think I ended with what I started with in the lesson of buying stocks during a bubble. Pretty much gave up on buying any stocks since my Lucent and Cisco experience in the late 90s, early 2000s.
But you're still hooked on the industry, or were you more interested in computer science?
I was hooked on like I said, I loved the investment world from the start. From there, I was hooked on it from the start, computer science. But I think that was the interesting piece it was something my father said to me when I was looking for my first job. And I was really concerned whether I was going to go into computer science or if I wanted to go into the investment world. And he said to me, and it's special because he just retired this year at 75, and he had his biggest year of his career as a lawyer at 70. So I always feel I have a long way to go and a lot to live up to have the top of your career then. And as we sit here, no matter which path you go down, he said you will in turn get to use those skills later on. And I feel like that was something that just stuck in my head. And I didn't get it, quite candidly, because my first job out of college I was a wholesaler for Lord Abbott. Unbelievable learning experience, the training program, almost cold calling brokers for a living. That's something that has stuck with me to endless proportions. Even then going there and working at ACO, which was a subsidiary of Goldman, was also another great experience. But when I joined what we are today, when I met Steve Braverman in 2006, and the idea was how do we create a single family office for multiple families, we went into a firm called MyCFO, and there were some technology issues, and I started coding again. And so all of a sudden, I'm using my finance skills, my advisory skills, the marketing skills that I learned, the planning skills that I learned at ACO, and I'm also on the technology side. So there's just this unique blend right off the bat that still carries to this day with the amount of technology and systems that we do, that you got to use our technology, computer science, I'll call it top-down design format in a services business that's heavily related to financials. So I've always felt that doing this now, it's crazy, 18 years now, with the original group that was at MyCFO before we ended up starting our own company, Pathstone, in 2010, was the ability to use, obviously, the client-facing, the economic side, at the same time, computer science background to really accelerate the business that we're working on and have all those joys mushed together in one.
MyCFO was a notable firm at the time, and it made a big impact. Can you tell us about it?
MyCFO, as you go back to it, was meant to be, it was started by a couple of large tech entrepreneurs, founders of Netscape, WebMD, Snapfish, and it was meant to be the .com family office and mycfo.com. And the idea is how do we create a high-tech, low-touch business? They had 200 developers. It was early days of advanced advent on the reporting side and heavy accounting practices. They tried to integrate a general ledger and an investment performance reporting system, which never actually happened. And the reality was they started it and the bubble burst. So all of a sudden, all the developers in the early 2000s, it ended up Harris Bank bought the remnants of it, Harris Bank and Bank of Montreal. And in 2006, they met Steve Braverman, prospecting him as a family. The fascinating part was they ended up saying to Steve, hey, the Braverman family invented the powder-free latex glove during the AIDS crisis. That was the third event for the family. And Steve was actually...
What were the previous events? Do you know?
There was a original wig business in the early days of airfare, and the second business was in oil and gas. The Braverman family to this day are entrepreneurs. They now have a space company. They've had active horse ranches. I can go down the list of entrepreneurial ventures that they've had, and it's incredibly fascinating. Steve's issue, he's a financial engineer by trade. Their issue at the time was they didn't have anyone who could help with the accounting, the bill pay, all the other management, payroll for folks, staff in the home, and they were looking for a way to organize all of that. The answer was there wasn't a solution. MyCFO had some of that, and the idea was how do we build a single family office for multiple families? So at the time, MyCFO went to Steve and said, would you help us build what you would buy as the family? I randomly met Steve in 2006. I joined 3 or 4 months later to start this with 1 or 2 other people. One of our other founding partners, Alan Zachariah, was already at MyCFO in Atlanta. And our group built the business up to a nice point. 2008 hit. We grew right through 2008. Very proud of that. But the Bank of Montreal and MyCFO ended up coming back to us and asked us to cut a certain percentage of our team, even though we were growing. And that's when we went to MyCFO and Harris Bank and said, we'd like to acquire. We first tried to acquire all of MyCFO, but we ended up acquiring the East Coast practice and started formally Pathstone in February of 2010 with 8 founding partners.
What was the value of the MyCFO practice at that point?
We had about $1.4 billion of assets and 19 families. I think I'm still under NDA to this point on the valuation side of that. But
actually, I was thinking more about, was there any technological value? Was there any IP? It was not just the clients.
It was some of, I will just say, going back to 2010, I still feel this way to this day. It was some of the absolute coolest times I could physically explain. We had a white sheet of paper, and it was like, how do we build this single family office for multiple families? We had 19 families to start and who believed in what we were doing, and how do we create and build that house while we were living in it? And we still work 7 days a week, 24 hours a day, but it was literally just a sprint of getting reporting on board, the right systems on the bill pay and accounting, and this initial team of people. We grew that from $1.4 billion to $4 billion in 3 or 4 years.
What was that first year like? Who were your first hires?
There was members of the team that we already grew up with at MyCFO, dating back to 2006, 2007. Alan and some of his team members dated back to working together since 2000. And so you had a group of people that already trusted each other and 7 or 8 founding partners. And we really focused on this business model. I think something differentiating for us is we were born from origination as a practice that was integrated on a single idea of having a single phone call and a matrix of services that we do investments, reporting, bill pay, do the payroll for the household staff, do the tax all in-house, aircraft management, hire the pilots, find the dog walker. We don't walk the dog. Work with property managers. Literally, if you could dream it, we would do it. And it was fully integrated from the start. So it wasn't an idea of an investment firm that, let's say, buys an accounting firm and now tries to offer services. The business model from the very, very beginning was to be this single phone call in a proactive offering for ultra high net worth families. And I think that's just something that in our DNA and our culture has really helped of how we've been able to structure the business.
So a classic problem in wealth management is how do you charge? And do you have an asset-based fee? Do you charge for services separately? You folks have planted a flag on pricing services separately, and you have an extensive service matrix. Maybe talk a bit about the rationale behind that and how you developed your first matrix.
I give a lot of credit back to our founding principals. Alan Zachariah was ex-Arthur Andersen, ex-Grant Thornton. And I do not want you to think that we're an accounting firm principals to start, but there was a discipline around, I'll just say, scope of services that Alan helped us bring from the very beginning of the business, where we defined what we were going to do for families, fully customized, unbundled. We thought that there was a problem in the market. We just watched this. We have other founders of GenSpring that work with us to this day that we've had long conversations with, and some other early entrants into the market. We looked at the trust company models. We looked at the broker-dealer models. And I'll say, if you look on the side of where you priced us on basis points, and if we have a heavy services component of the business, the biggest issue we saw is that, I'm making this up, if you charge 80 basis points, you're sitting there saying, pretty please don't use my lawyers, don't use my bill pay, don't use this. Anything you consume reduces my margin. Are you really going to staff those services with the top people if it's really like an expense center versus it being a revenue generator for the firm? And that's why we unbundled from the start. We say, why don't you tell us what you want to use and what services you need? What are your pain points? Let us do those and have top professionals doing that. We now have 150 people that are solely dedicated to services at Pathstone today, between trust, accounting, bill pay, concierge, etc. And that's something that's, I'll say, allocated in block time. We understand our costs, we understand our fees. It's not a loss leader for the firm. And so now we're able to provide, we believe, a much better service because of that belief. And if you want us to handle investment management, we absolutely can do that. And we do offer that on basis points. If it's a more mature portfolio, a lot of times it may be more on a retainer based. But we're big believers in being able to consume what you want versus trying to offer to some all-encompassing fee that some things we believe get lost. And that's how we believe we can deliver better service with more talented people.
And how do you think about the pricing of each of these individual services? You offer quite a bit, and they're very distinct. You'll do security, you'll do tax planning, you'll help figure out the horse farm. But are there things that are outside that you felt like you couldn't price properly? Are there things that took a while for you to figure out?
I'll just say there's an obsession of insourcing at the firm. We have found that the second you make a referral externally, you no longer control that experience. And so everything we do is at Pathstone, all onshore. The only thing that we outsource is medical billing, but we built a technology bridge, and that's from around certain HIPAA rules around that. But even on that side, we have a technology bridge that when bills come into our bill pay system, based on the GL coding, goes out to a medical billing company. But everything is about experience that you're trying to have. And so how do we, I'm going to call it, perfect the client experience, or at the same time, control that experience? And we do that by insourcing. So when we started Pathstone, the matrix of services was about 6 pages, and today it's 14. And I'll just say, as Pathstone has grown, we have grown horizontally and vertically. And I think that vertical integration over time has been an important part of why our clients continue of what their needs. Trust services was a really big aspect of that, and that we were missing. So we were going through down the line and saying, what is the firm missing? Trust services was a very big piece of it. Enhancing technology and services internally. Unlike the MyCFO model, which was supposed to be high-tech, low-touch, we are high-tech, ultra-high-touch. So how do we enable people to work more closely with their clients and be able to have a higher touch model by doing that? And so we keep just adding services, property and casualty advisory, health insurance advice. These are tough things to deal with. Insurance companies, if you just go to the market yourself, and you're in Florida or California or places with wildfires or flooding or hurricanes, it's hard to get insurance. You have a giant claim. We had a client who had a home in Colorado that the home shifted and incredible structural damage. We handled that from A to Z on the claim process. And so that's where we added philanthropic advisory, helping to write mission statements. At the same time, we also can do the tax returns in the 990s. And so the idea was, how do we become that single phone call for ultra high net worth families to get professionals who have these experiences that know how to deal with these things as they pop up?
What's included with the investment base fee. Is what arbitrates where the line is? Is there a minimum that people are paying?
It is on the investment fee. If you look at our matrix of services, I'll call it the first 3 pages are advice, reporting, and administration. So when we charge basis points, it typically includes those 3 things. We do unbundle them. And so there are many families, say, that may hire us for reporting, accounting, tax, bill pay, but we may not be managing the money day one. And I think that's also a pretty big differentiator of the firm, is that you could become a client and have this single family office for multiple family feel, but we don't have to manage your money. And I'll just say that has been something that's been helpful, and it's something that the way we continue to run our business. If a client later on wants to hire us for the investment side, we're thrilled to continue to expand services, but at the same time, we don't ever have to manage money. The largest revenue paying client of the firm today, we do not manage any of their money. Now, we run cash flow analysis, we manage 7 homes, we manage the foundation, we move money between Goldman Sachs and Morgan Stanley and Bank of America on a daily basis, but we don't directly manage the money. And I think that's, again, why people hire us, and there's a gap in the industry, is people want the assets and they want to charge basis points on the assets, and we're kind of like, we're unbundled, use what we need, and you have 14 pages, and I hope it's 20 pages a couple of years from now, of things that we can help you with. And that's been a very successful part, I'll say, for the client experience and for the business as a whole as well.
Do you think services could become a profit center?
Services are a profit center at Pathstone. If you don't run it in that manner, is our belief, then you can't hire the top people in the industry to do that. If you're just a cost center, I just think that changes the game, and it changes how you're delivering that services. And we don't run our services at break even. We don't discount services. We have very premium professionals that we do charge a premium fee for those services.
So let's talk a little bit, we'll back up and we'll talk a little bit in general terms about consolidation and wealth management, and maybe how today is different from the way it's been done in the past.
Yeah. I'll just say I don't think it's a consolidation. I think there's a concentration that's happening. I think as you look at depending on which study you read, someone will say there's 22,000 RIAs, someone will tell you there's 16,000 RIAs. But if we say 5 or 10 years from now, I think there'll be 25 or 30,000 RIAs. I think the assets of the RIA environment will be more and more concentrated in a couple of large players. But there's a reality that the local RIA is here to stay. They're going to be very successful. They'll continue to grow. They will be more lifestyle practices that when the person looks to leave, they'll probably have to sell or clients will disperse. And there's going to be, I'm going to sit here and say, there's going to be 5 to 10 very large RIAs that are going to start approaching things like $1 trillion. And the market will continue to change rapidly. And at some point, I think the banks and the broker-dealers are going to shift some strategy because they have a lot more money and a lot more capabilities. And I think the proof point of this is when you saw about a month to 2 months ago where Goldman Sachs announced that they'll now do family office services for a fee, not included in their basis points. So they're not just going to sit there waiting for a $1 trillion competitor to show up. There's going to be inverse disruption to the disruption as we sit here. And I also think as some of the larger RIAs, they're going to have capabilities that the smaller ones won't, but there's still going to be clients who want to go to a local business that has $100 or $200 million, has a nice relationship, and I think those are going to continue to be successful. At the same time, I think us and a few others are going to become very large RIAs that have a different business model than the banks and the broker-dealers as we push forward. And I think the other part that's just shocking to me as I'm sitting here is, and I'll say we have the benefit of working with some of the earliest RIAs, Hull Capital, Veritable, that were started in the 80s and 90s, Federal Street Advisors, where they started these businesses because they were trying to get away. They were trying to be true fiduciaries. They were trying to be conflict-free. They were trying to get away from layers of commissions and fees and all these things and transparency. They were trying to get towards transparency. Fast forward, I look around in the RIA market. We meet with a ton of firms every year. We're literally starting to see fee schedules come back that look like broker-dealers with different fees for different asset classes. Double dipping of investment product is literally everywhere again. So all of a sudden, the other thing that's happening is, and whether it's greed or the business model or whatever it may be, and everyone deserves to get paid for their work, the RIA market is actually, in my perspective, starting to look a whole lot more like the broker-dealer market. And there's very few players that are staying pure to that original thought behind it was there's always going to be conflicts, but how do you have as few conflicts as possible as you continue to push forward? And that's just something we've stayed true is there's one way to collect revenue is what our clients pay us in a fully transparent manner. No soft dollar, no hard dollar, no strange fees, no double dipping. But the industry is leading that model, which is shocking to me.
So your march of acquisitions is impressive, but it only started in 2016. Could you tell us a bit about the discussions at the time that led to your first acquisitions? How did you know you were ready to take it on?
It was part of the business. It's a very good friend of the firm, an old friend of the firm is the Nesvold family. And Steve Allen and I were meeting, this was back in 2014 with Liz, and she saw what we were doing. And we got to a place where the firm had 50 clients, 35 people, and a small group of the founders would typically go to every meeting. I'll say a flaw of a North Jersey office. Of the first 50 families, I believe we had one New Jersey family and one New York City family. And so 50 clients, 4 meetings a year. We were flying all over the country with a small group of us to every meeting. And that was where, I'll just say, where Liz came to us and said, you need some more adults in the room. You need capacity. You need more capabilities. You need to find a like-minded firm like you guys if you want to continue to grow this, where what you're doing just isn't sustainable. So that's when we took on our first outside capital. Back in 2014, 2015, you have so many options for capital now, but what people don't remember is you had 3. You had Focus Financial was the dominant player. You had AMG, and then you also had Fiduciary Network, which is now Emigrant Partners. And Focus, I will just tell you that the pitch was fantastic, but it felt like you were selling 100% of your company for 50 cents on the dollar. And we were very worried about how it would work from a sustainable standpoint. Fiduciary Network was offering a convertible debt structure that seemed very complimentary, and it allowed us to go on this national search. And that's when we met John LePan and Kelly Marini with Federal Street. And John was a founder, like I said, a firm that was one of the first RIAs in the industry. And Kelly at the time was the top advisor in the office. And fast forward 11 years later, Kelly's the president of the firm. The in-house research of Federal Street, we outsourced research initially with Rogers Casey and Wilshire and Fortigen, and they had in-house research. And the other thing we learned right from that, other than getting talent and capacity, was this eye-opening experience on the research side of capabilities. And so all of a sudden it was much more than Pathstone brought technology, Federal Street brought research and talent and people. And we realized by this combination side that if you found the right people and the right partners who actually want to combine, not a company of affiliates, that we could continue to add these capabilities to the firm. And the other issue we had is we had trouble hiring at the managing director level for people who knew how to work with $100 million families. If you're a top advisor who knows how to work with $100 million families, you're probably well off onto your career at another firm with equity, and you're not going to leave from a recruiting standpoint. And if you're at a broker-dealer, it's a very different culture, so it's hard for us to try and attract, let's say, teams. And so we quickly realized through this process with Kelly and John LePan that we could add capabilities to the firm through acquisition to continue this, I'll say, vertical and horizontal integration, and at the same time also find partners who know how to work with $100 million families. And with technology, someone could work more closely with more families once they meet us. And so that was really this genesis of the advice from Liz, taking on Fiduciary Network that was originally run by Mark Hurley and Ben Robbins. Ben runs Tria Partners now to this day in a similar model. And that was the dawn of this awakening of saying, wow, if we bring in really high quality, talented people, we can continue to expand. And if those high quality, talented people are there, the other flaw is where there's one rainmaker at a firm. I'll tell you, Federal Street grew very nicely. Old friends of ours, it was a firm called Convergent, which was owned by City National Bank. They ran into some issues and they joined us in 16, right after Federal Street. And all of a sudden you had incredible leaders in DC, incredible leaders in LA, Kelly up in Boston, New Jersey, and Atlanta. And we had an early family office join us in Florida that still exists to this day. And all of a sudden we had a decent footprint and we're like, this works. I'll just tell you on the integration side from the start, Steve actually moved to LA with the LA office and really grew our presence there. I lived in North Jersey, but I almost lived in Boston for a year. And that started all of these kind of early foundational elements of how do we actually integrate, but at the same time find people who want to integrate, who actually believes in creating an enterprise if we meet somebody in this search for capabilities and talent and capacity, and they want to just keep doing their own thing, they shouldn't join us. And that's an area that we haven't missed on. If someone sees the vision of trying to create a national brand for the ultra high net worth, and we started seeing that early on in this business model of being a single phone call, we've been able to grow organically in a very strong manner. I know you see statistics that RIAs typically grow at 3%. We've been able to do multiples of that because we believe this business model is attracting clients in a completely underserved market where large families cannot find these services all together under one roof. And that's been something that's been helpful. So the integration side, again, early lessons. We then combined with some folks in Seattle, incredible partners to this day. And after people join us, we also tend to see a pretty interesting curve on the growth side because you're able to offer so much more. And so now we have the ability to show, not only do you join us, have we grown nicely, and can we do more, I'll say no change for clients, but here's where we can enhance. And now you all of a sudden have more that you can offer your clients that you weren't able to in the past. And that's really what's been, I'll say, the engine on the organic side, in addition to the inorganic side, which also has been helpful finding the right partners throughout the country.
So how does a practitioner value a wealth management business? I'm sure you see it's a lot more than just a multiple.
Yeah, I think it's partners and culture and people. I'll just say this. We meet so many people. If you are not, there's also a giant talent gap as well. When we meet firms, if there is not a cultural alignment, I know this sounds ridiculous, but in our process, we don't just do business meetings. We try and go and do things and hang out with people because you don't get to know them in a business meeting. You don't know what it is. And it's not when you think you're dating and then you get engaged, things change, you get married, things change. We really want to get to know you. We're gonna have to spend a lot of time together, and you're gonna spend a lot of time together with our partners. So if these aren't people that you want to spend a lot of time with, it's not going to work. And I'll just tell you, if as you go around the firm, the people who have joined us, these are real friends and partners with us that you want to grow something. It's what makes it exciting, doing something and building something with your friends. And so there's this kind of big test, I'll say, when Kelly and I and Kevin Casey, who runs corporate development and strategy for us, when we're meeting these people and we bring other people in, it really needs to be a consensus that these are people you want to spend a lot of time with and grow a business with. And so I think there's just this massive cultural part, and where we see red flags, we just cut things off. The classic one is, can we continue to run our own investment platform? That's the wrong question. It's really, what are you building and what have you done that we could then offer the rest of the firm that's differentiating and unique to the marketplace? And so when we start seeing those red flags, we just cut off conversations. That's where multiples, money, none of those things matter. If we bring someone toxic into the firm or something that doesn't fit, this thing will fall apart. And I think that's been a big piece. Again, on the multiple side, we've all seen them increase. I think there was a flurry of outside investors coming in over the last couple of years. What has started to normalize again now, which is, I think, just healthy, is where is the organic growth rates? And if someone has a high organic growth rate, it will command now a higher multiple. When people see lower organic growth rates or things that might be stagnant, those are now commanding lower multiples versus the frenzy that I'll say that you saw for the last 5 years. You're really starting to see valuations come in line with things that make sense.
How much consideration do you give to the client size?
When I think about our business, 92% of our business are family office clients. Our family office clients average $170 million. But we are looking to stay in the ultra high net worth space, 25, 30 million and above. So that is the market we excel at, but we also have a large number of clients below that we continue to serve well, but our focus continues to be on that 25 and 30 above market for the firm.
How did you find alignment with your private equity partners?
I love that question, and the shocking answer back is it's culture and people. No different than the people that we work with who come online. I've been fortunate now to do 3 full searches for investors. And I know I said that we only had 3 choices back in 2015, 2014, but I will tell you that Ben Robbins and Yvonne, who are our partners, and Steve Cortez from the beginning, Ben Robbins to this day is still a very close personal friend of mine. He gave me my MBA in M&A, taught me how all of this works, taught me how the structuring works. And normally you don't think that your investor is your friend. And maybe I'm living in too much of a opionic thought process as I'm sitting here, but I think it's real. And to this day, Ben and I keep close contact. We got to a point with our first investor that the convertible debt The model no longer fit. We went from 4 billion to 16 billion in about 4 years. And a lot of that was organic and very successful. And we got to a point where we then had equity value in the firm. And so if you just think of your structure, we took on debt when we had no equity value, took on an equity partner in 2019. We did an expansive search again. Liz and Peter helped us out through that. And we ended up finding a personal connection. The market will set the price. That's the one thing that's really fascinating to watch through all these processes, the deals we've done, the investors we've taken on, the debt financing that we've taken on from different parties over time. The market will truly set the price. There's enough players out there now that you can be picky. And we just hit it off with Level Minute Partners, with Brad Armstrong, who we work with on a day-to-day basis, and Jenny Thapa. We knew that these were people we wanted to work with. Again, you're going to laugh when I tell you this. We made the private equity guys go hang out with us, and not just business meetings. And you go and you hang out and you things of who's making weird comments you don't want to deal with and who are people you want to speak with. And I'll just say Level Minute Partners has just been one of the most stand up, on your side. They've been our biggest cheerleader. Where can we support? Where can we invest? We went from 16 billion to 80 billion with Level Minute Partners in a short period of time. We got to a point where we wanted to continue some succession planning internally, but at the same time, bring on additional equity to continue to grow. Went through a similar process in 2023. Level Minute Partners, a lot of the same that I'll say from a cultural perspective. And we literally left the meeting with Bill Fryer and Steve Dunn. And we're like, these are people we want to work with. And again, the market, as I sit here saying this, the market will set the price. Who do you want to work with? So we've been fortunate that we've handpicked each of the investors. Level Minute ended up moving us from Fund 5 to Fund 6 as part of that. So we were able to keep another chapter with Level Minute and continue to work with people that we enjoy. And they also get our vision. They really believe in what we're trying to do in the ultra high net worth market, what we're trying to do as a culture. Because at the end of the day, in an advisory business, if our people are happy, our clients will be happy. And as a result of that, the business will do well. And that's how we've been able to continue to run a profitable business. And since Kelso joined, we've gone from 80 billion to now $162 billion of assets that we either advise on or administer to.
There's been a lot of excitement in the space. Have you explored other forms of expansion capital?
Yeah, I mean, there's more options now than ever as we sit here today. I think we've seen, I'll say, if you look at the market, Focus Financial was your public company comp. I don't think the public markets valued or understood how to value it, even though it had a pretty nice size market cap. On the flip side, you're really seeing success in the private markets that's continued to push forward. A couple of folks have gone public. You're also seeing a lot of new players come into it's not just private equity, a lot of preferred equity. I think that Carl with Constellation now has come out with another form of capital that's a little bit of a combination of pref and common and convertible. I think you're going to keep seeing more capital coming here. And the reason is these businesses in the RIA markets look a lot like software as a service, like revenue models at this point, where even the bad RIAs, laugh when I say that, their retention rates are still in the mid to low 90s. And the top RIAs are closer to 100% of retention. So you have a very high retention rate, recurring revenue business that has the market to grow alongside with organic growth. And a lot of people are putting money to the space. If you think about it, it's not much different than what you saw in the insurance space, called a decade ago, and other business lines. The insurance businesses have been rolled up multiple times at this point, but you still see their multiples holding in like high teens. And so when you see private equity firms come in, and we've all seen different headlines of TPG and others recently of paying north of 20 times multiples for platform-like businesses, you look back to what's happened in the insurance brokerage world, very different business, but similar recurring model, like where, I don't know if you could ever remember a time where you didn't get your homeowner insurance or your car insurance go up every year, that those folks are getting recurring revenue on. Those have been maintained through multiple market cycles. And I think that's what people see is that a non-platform business will go in low to mid-teens, and platform businesses that are showing their growth could go high teens, low 20s, and on the multiple side. And I think that's here to stay for the foreseeable future.
Can we talk a bit about the integration of these acquisitions? I know you have a bit of a playbook. Could you tell us what's in it?
The playbook just came from learning. It's mistakes that we've made. None of us are perfect. And our project management team is called our Center for Innovation, and they work with all cross-departmental projects at the firm. And that's what runs I'll say the blocking and tackling of are the phones or the email or this. Have we set up meetings with different departments and everything else along those lines? On the integration side, as we get into the playbook, we start meeting people. I think the coolest thing that I look at when we built this company, I am the last remaining person on the management team from legacy Pathstone, is completely made up of unique, talented professionals that we've met from different backgrounds and different experiences that have come together to build a management team to try and create a business or a first-of-a-kind company, I'll say, that's yet to exist. We do have some professionals on our CFO side and chief people officer side that come outside the business or outside the industry, but finding those unique people who want to grow and want to innovate and want to create, that's what's made up the management team that's been really special. So as you're going through this, I'll say, playbook of figuring out what are the capabilities, and if someone's running a Salesforce instance, it's not Pathstone comes in and is, here's the Pathstone Salesforce instance, shut yours down. It's show me what you've built. Have you created a live example? In Colorado, they created this entire integration with private markets demand and even a look through portfolio companies and overlap. And yes, do we have full-time Salesforce developers who are very talented in-house at Pathstone? Absolutely. But every time we see these new things that were created, how do we create this private equity demand system that was built in Colorado and then offer that to the rest of the firm? And so it's this idea gen and idea flow where I'll just say I'm still to this day almost giddy every time we meet a firm. What have they built and what have they created that we can then build at the rest of the firm? And so in the end, yes, we do all get on the same systems. We do all get on the same order management systems. We work with a lot of different custodians throughout, but this learning process for months that we go through it is our playbook to then make decisions. But the decisions we're making is typically incorporating technologies and idea flow of the firm that's joined us into the rest of the firm. And from an adoption standpoint, I'll just say the management style that Kelly and I have preferred from the start is like, if we're able to offer people awesome things, you get full adoption versus going to somebody and saying, you must do this or else or leave. And I'll just say that theory of creating, and I'm laughing saying awesome things, is something that we are focused on to this day. And when we roll things out, you get adoption because it's either making people's lives easier or they're excited about it. And that is where I think we've had the success on the integration, especially on the flip side, on the client side. In the early stages when we get together, showing new clients where we can help enhance services or provide new things, clients get excited, advisors get excited. I just had a really interesting, someone who joined us recently, for the first time was able to offer literally, instead of solely investments, everything. And he's, Matt, I feel like we invented fire on this. I'm like, I know, that's what I feel like we're doing here. So being able to do that really changes the landscape of what people can do. And I think it reinvigorates people, gets people excited about the business and gets people excited about serving clients. And at the same time, I think something really special and unique about the firm is about half of our people, of our team members, are shareholders. And so all of a sudden this growth and the business and how we serve clients, and it's still an old-fashioned business, if you deliver incredible service as a culture of service, you get more clients. That, along with the growth that we've seen, we're able to make this for folks at our firm. This isn't a job. This really hopefully becomes a destination for your career, and the ability to build equity value and having 3 rounds of private equity financing come through Pathstone. Everyone knows that every 4 to 6 years, you're going to have a recap. Someone new can come on, and it opens liquidity windows for our shareholders. And I think that's the other thing from a sustainability standpoint with the growth that we've seen, that it's hard to offer elsewhere. That, well, I'll just say my founding partner, Alan Zachariah, who's a best friend, father figure, et cetera, we've been able to have a full succession plan and not sell the company of a major shareholder because of the ecosystem that we've created, that we know that we have liquidity windows every 4 to 6 years. And so I will say it's one of the biggest benefits that I've seen. And I think we'll be able to continue to do this for the foreseeable future. I am not going to compare Pathstone to SpaceX, but I think there's a way that we can potentially stay private, not have to go public. Maybe we do go public one day. But SpaceX at a $350 billion valuation, I think what you're seeing in the marketplace right now, look at creative planning, look at Fisher Investments, look at as well, you're starting to get almost like a conglomerate of investors, multiple private equity firms invested in these larger private companies where they don't have to go. And so maybe the future, we are able to stay private and have a large number of shareholders. You see the pension endowment world also taking a look at this as well. Maybe larger private financiers continue to come in, or at some point do one of these firms actually go public that is a cohesive. In my mind, if I'm sitting here, I think Creative Planning is probably the first company that ends up going to an IPO eventually, or maybe they stay private. Who knows? But I think the world is showing us, and the market is showing us that we can stay private if we want to with the amount of capital that's coming into this side of the business.
Have you had luck integrating company founders with your acquisitions?
Yes, because the founders who've joined us, we typically don't buy companies where we're just buying someone out and they're leaving. We're typically joining forces of people with partners. And if someone is later in their career and looking to take a step back, the next gen is fully in place. So we won't look at something where someone comes to us and is looking at, bad example, but if there's a firm who has 3 founders looking to retire, we don't exactly have the next top talent sitting in Minneapolis to go in. It's really about someone has next gen, who's ready to go and excited. We look to equitize people. That's a big part of what we do. So if a founder is stepping back, if there's not a next group of folks who are hungry and exciting, we won't look to go into that new market or transaction.
Looking back on this tremendous growth, I'm sure there were challenges. Were there bottlenecks in the last 10 years where you had to move from a small to a medium to a large firm? Was that a step function or was that more of a hill climb?
I'd say a step function and a hill climb at the same time. A lot of it is people, and how do you have the right talented people in the right chairs? And sometimes you might start the firm with different friends. As that you're building a company, you need to make different decisions of finding homes for them in the firm as you continue to grow. The other thing I'll just say is I look at this in 2019, when we were making this decision after the convertible debt, do we take on a private equity professional investors, I'll say? There was another option we looked at of, do we just take out a whole bunch of debt, take out the old folks, the immigrant partners, and do we work on our own internal succession, or do we go forward? I will say having professional investors who have done this before, not necessarily directly in exactly what we're doing, but having independent board members as well as part of this, there is advice and structure. Having Mark Tibergien on our board, having Vamsi, who ran M&A for Focus, having Ron Cordes on our board, who founded Asset, Lovell Minnick bringing in advisors like Stephanie Shelley, who was the CMO of Citi and Capital One. This level of professional advice helping us work on the business. Don't laugh at me when I say this to you, but when we were growing the business, we were just growing it. And whatever money was in the bank at the end of the year, we split out between the shareholders. But sitting down and writing a 5-year strategic plan, when you take on an investor, writing a strategic plan every year with some top minds in the industry who've grown businesses, and getting a little nudge. Hey, Matt, right when we met Lovell Minnick, $16 billion, they're like, you need a CFO, you need a chief people officer. That's something we wouldn't have come around that to ourselves, but adding these levels of structure and discipline and having a board and having these types of things, I would say has accelerated it. We were sitting in a board meeting, this was in October of 21, and this is the idea came up in the board meeting, we're missing on digital, right? And we're not doing digital marketing. What if we spend $500,000 in digital? And I'm not, again, it's just, and then bringing in the professionals like Stephanie Shelley, who is the CMO. How do you not want to listen? If Lovell Minnick has access to these icons in the industry, how do you not want to bring in these advisors about part of what they're doing and their business plan of how they help to grow companies? I'll just say the advisor network between Lovell Minnick and Kelso has been game-changing for the firm, and bringing more smart people around you to help grow this. The professional investment side of it, we never would have been where we are today if we didn't have the right partners that we brought on. And I think that's just something I'll say that's missed and overlooked as we push forward.
What about challenges? Were there any sleepless nights?
Yeah, a lot. You're growing a business. In the early days, I'll say one of the lessons, we bought a business that was in trouble, but we thought the people that we met were just incredible.
Convergent?
Yeah.
Yeah.
We hired...
Tell us that story.
It's a very sad story. There was a firm that was originally called Lydian that broke into Fortigen and Convergent, and that was one of our original technology partners. We did some incredible innovation with some incredible friends that start that business. And Convergent and Pathstone were two very large users of Fortigen, and that's how we had contacts at conferences and everything else. And unfortunately, there was an issue at Convergent where the CEO committed suicide, and very sad. Friends in the industry, friends with our partners. That business, Convergent, was the hottest RIA, I believed. It was the hottest RIA at the time. $12 or $13 billion RIA in 2014. They had folks, again, I look Some of the folks, the person who ran their CRM runs all of our development of our CRM today. Their head of strategy is the head of strategy, investment strategy of Pathstone. Just like incredible Allison, who runs operations for Pathstone, was in research operations of Convergent. We just kept meeting people there. They had the top talent at the time. We hired way too many people as the business was having issues from the history of what just occurred. And so 2017 was a year that we looked at ourselves and were like, this is a challenging year. But moving that aside, that end up story from where it goes, the DC and LA markets are two of our fastest growing businesses in the country. The DC market's been our fastest growing in our market in the country from where that started. And the reason was it was top talent and top people. But we've made mistakes. There's no doubt we really value ourselves on the technology of what we're able to build. There was a situation where there was a legacy system that the contract was running out, and we thought we had it all set on the new system, and we didn't. Even my mother yelled at me over that one. I was telling her the story. I was stressed out, telling her what happened. And my mom goes, so why did you turn off the old system before the new system was on? I'm like, Mom, thanks for rubbing it in. I'm still not sleeping, and I'm having gastric issues over this. And we've learned a lot over time. We've made mistakes. That playbook that we talk about on the M&A side, yes, we do have a 23-page playbook that we go through, but it's different every time and different people. And the only way you learn is by making mistakes and getting kicked in the teeth every once in a while and continue to innovate and build from there.
What is the key to organic growth, and why do so many RIAs struggle?
I personally believe it's just service. The highest level of service that you can find in growth-minded people. And
why does the industry struggle to deliver that?
I think you have a lot of lifestyle practices out there that aren't looking to grow as much. And then I also think the offering is the other gigantic issue that has occurred. If you just offer investments, you're not growing. And I think that's just something that we continue to see over and over. And I'm sure there's outliers to that. But as we go around the country and meet with other firms, investment only has become completely commoditized. You can go to any firm on the street, and however much anyone wants to say the broker dealers and the banks are conflicted and blah, 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 you can go to JP and Goldman, or you can go to a trust company, and you're going to get a super solid, globally cap mark weighted asset allocation. And sure, fees can be a little different here and there. You're going to be fine. How do you create differentiation? And I'll say the other thing, you're going to laugh at me. The other thing, latest at RIAs we meet, everyone thinks they have the best alts. That's the newest thing that you now see. And I think people realize doing direct investing is hard and various other things. But I just don't think that if you're not offering other services, you're not growing, or you're seeing margin compression. And if you are going to have an investment platform, how do you actually offer something that's differentiated and different? I think our ability to do programmatic tax loss harvesting at the portfolio level is truly differentiating. I think some of the things that our new partners in San Francisco and New York from Hall Capital have done are truly differentiating. And I think that is exciting, but you're starting to see other firms add more planning. And that was something that was started forever ago, but you're seeing more of that, and you're starting seeing the demand for more services. And so I just think that if you're not offering a full suite of services and you're investment only, which is still the majority of all RIAs, they're going to have trouble continuing to grow. And if you don't have growth, this is from our perspective, and not the market, right? This has to be growth X market growth. If you're not growing near 10%, how do you keep your talent, right? How do you have the right raises? How do you have the right bonuses? And if you're not growing, how do you have new clients so that your number twos can become number ones? And so absolutely, we're sitting here, do you need an organic growth metrics to keep your multiple of the business? Yes. But unless you're growing, you're also not going to create this firm that's a destination for your career, which then means you're not going to have the right service for your clients. And if you're not delivering the right service to your clients, those clients are not going to recommend you to other people. This culture of service that we do, we focus on creating moments that matter for our clients. When you have something where, you have a story where someone is in Texas and they find out that their mother is sick or dying in New York, true story, and they say, can you get me there? Can you get me to New York? And we have a plane on the tarmac in 90 minutes. How do you replicate doing things like that? My son's looking to get engaged. I'll go shopping with him. We'll go get the engagement ring together. These are real things that we do, and we very purposely think about creating these moments that matter. Again, fixing the property and casualty issue on the home that shifted. When you look at our clients, they're not telling you, I can't believe, this is so amazing. You picked the best large cap manager for me last year. It's about clients may not hire us to give them a preferred life, is what I'll say. But once they do hire us and we create these moments that matter, we are able to give them this preferred life. And that is what the business is growing on, not what stocks you're picking. By the way, it's like table stakes that you have a strong investment platform. But how do you create moments that matter for these individuals and create the preferred life? That's what creates organic growth at the firm.
And as a business person, where do economies of scale come in with ultra high net worth clients?
I look at the businesses we grew until we hit like 10 billion. I'll just say, looking back on it, we couldn't spend extra money on things, and you couldn't take shots and make investments because you need the money to continue to reinvest. As we've continued to grow, you're right. If we want to go into digital and go spend 4 million or 6 million on digital marketing, we can now. If you want to go bring in a top talent, I just watch and look. If we have 150 people in our services division, if we want to bring on a new head of professional services or a new expert in tax, we can afford to do these things and know we're going to have multiple years to recoup that investment and show a return on that. And that's just, I'll say, as we 10 and above is where I'd say we were able to start investing. 50 and above, as we look at it, you are starting to make differences where we have talented people at the firm on education and governance and estate planning and family office structuring and tax that we never could have afforded and been able to show the return on. And that's where at the end of the day, when I sit here saying the $1 trillion RIA, the reason I say that is because you can offer things that people just can't as you start getting to size. And they even look at our size, and we're still tiny, right? We have 750 families that average north of $100 million as we sit here today. We have no market share. There's, according to a good friend, and I believe it's from Cerulli, from Jamie McLaughlin, there's 230,000 families in the US that have north of $30 million. We have 750 of them. We have no market share. It's a gigantic blue ocean. I think there's a generational opportunity as we're sitting here to grow and become this national brand that I just don't think anyone's going after. And I think most of the other firms we know have gone down market, and we haven't, and we're not going to.
Where does OCIO fit into your business lines?
I believe it's interesting. That word, I'm going to say, is a naughty or a nasty word, but that's part of our research department, right? If we don't have differentiating investment offering, we are absolutely the outsourced chief investment office for a very large portion of our clients. There's only 2 clients in all of Pathstone that doesn't even touch anything like performance reporting or investing or anything or administration. They're tax-only clients, but I just think that's table stakes. And even if you are the OCIO, folks are looking for more than that. And I've just seen this even on the institutional side, which we have rough numbers, call it $12 to $13 billion on the institutional side of the business. We're still doing more for those institutions than just straight OCIO. So I just think that's table stakes. That's the commoditization, what you've seen. And you have to be able to show that you have more than that.
Where do you come down on facilitating direct investing or co-investing?
Co-investment, this is an area, I'll say that you see all this demand, people saying we can do direct deals. I still sit here, even with a team of north of 50 people in the research department. You leave that to the professional investors that are staffed to doing that on a day-to-day basis. Co-investment side, let's use our size and scale to negotiate programmatic co-investments, help buy down fees, negotiate fees and pricing. I just don't know. And it's also just the business model, right? So if you're in a private equity firm, people are investing in Pathstone, right? Lovell, Minnick, and Kelso have carried interest. They're incentivized to find these companies, to sit on the boards, become part of the business. We're not staffed to sit on boards of individual companies. We're staffed to sit on LPACs of private equity funds and find unique investments for our clients. And our compensation structures, we're salaried and bonus. We're not on commissions. I'm not trying to say we're in some utopian society. We're obviously capitalists. We don't run on grids. We work for the families. And the other thing from the business model standpoint is we want our individuals and team members incentivized on making a great living and driving the value of the equity at the firm. If you start introducing where a small group of people are getting a carry and different ways, you're not all swimming in the same direction anymore longer, in addition to the fact that we're not staffed to do that. And if you do staff to do that, then you probably have to charge for that, and that probably starts messing with the entire structure of our fee structure that's there. So as we're sitting here today, I just don't think even at $162 billion, we are not staffed to buy direct companies. We are staffed to do co-investments with our partners and our funds, but we're not a private equity firm. That's something we need to lean on our partners there, and we'll do co-investments with our partners.
Do you think that's a deal breaker for a new client?
I think it's an area that people understand. There's organizations, 3i is something we're closely related to, that if someone's really looking for like a deal makers group, we end up working with 3i directly on that. There's a couple other organizations as well that if people are looking for that more direct deal side, we'll introduce and offer that. But us ourselves going out and finding the next copper tubing business, that's not our business, but we know how to show clients access to that if that's what they're looking for.
Okay, Matt, you can only choose one, Springsteen or Bon Jovi.
I'm from Jersey. I always think we're living on a prayer, but I'm still a Springsteen guy. He's the only one who can sell out Giant. I'm not allowed to call it MetLife Stadium, not Giant Stadium anymore, for a month without an issue. So you still have to go with the sustainability of Springsteen.
Matt Fleissig, thank you so much for joining us and sharing your wonderful insights.
Had your pleasure being with you.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.